But let's connect then with Rahul Singh, Chief Investment Officer, Equities at Tata Asset Management, to talk about the mood of the market and where he's finding favour. Good morning and great to have you on board. To start off with, let's talk about the overall election event. Do you believe that, some sort of a clear verdict on the election front is likely to reduce the event risk for the equity markets?
Yes, I think the key thing to watch here is that the verdict, whatever it might be, it has to give a stable government which lasts 5 years, which can make policies for 5 years. As it is, the number of policies which are pending or the number of major reforms which are pending has reduced. So really from the election verdict, what we are looking for is stability for a longer period of time. And I think to some extent market is already factoring that in post what has happened end Feb. So I can't say that there is no expectation that is not already partly in the price. But from our point of view, I think what we continue to focus on is the themes, the earnings, which frankly, even if the government changes or even if the government is not as strong as what it was for the last 5 years, some of those drivers of earnings in the market are not going to really change their course materially. So we need to keep our eyes on that. Yes, of course, there is an element of flows, there is an element of FII flows which will get impacted, but there is also a substantial amount of cash waiting on the domestic side to be deployed. So net, I would say that it is partly factored in. At the same time, if there is an expectation, if the results are better than expected, then there could be some positive upside.
Rahul, what's your sense about what we're hearing from a Yes Bank? As disastrous as the quarter may be, and the kind of reaction that we're seeing on the stock price this morning, where it's sliding almost about 25% do you sense that somewhere soon it's going to get into value zone? It is a new management, it will get into the cleanup act, and there will be those skeletons coming out of the closet. But the cleanup could happen faster this time. Or would you say that, or rather, would you not be willing to give Yes Bank another chance?
I'm sorry, I cannot comment specifically on a stock, but corporate banks is the space we continue to like, which has been through that process which you're talking about already over the last 2 to 3 years, and they are now coming out of that cycle of NPL recognition and provisioning. So we would much rather be focusing on the banks which have crossed that hump, which have been through that transition period, have made some tough decisions on NPL recognitions, although prompted by RBI and so on at various stages. So it has taken longer than what it should have. But clearly the momentum in terms of the earnings, ROA improvement is very, very clearly with those banks. And I think events like these will probably bring into focus more of these banks as to the kind of divergent trends which you're going to see in corporate banks. So, without getting into specific bank names, I think that is what we should focus on for this year, and it's already played out, and I think it will continue to play out over the next 6 to 9 months.
PSU banks as well. Let's get your view there, Rahul, because today seeing a major cut coming in on the PSU banking names as well. I perhaps, of course, what we've seen post the Yes Bank earnings impacting the overall sentiment as well. But when it comes to whether or not you'd allocate, to PSUs versus some of the corporates, what would be your strategy?
Well, all the PSU banks would come under the corporate bank category, and we are not necessarily averse to owning PSU banks, but at this stage, barring 1 or 2 banks, none of them really look very good in terms of the near-term upsides in ROE, ROA. And clearly, the private sector corporate banks are one or 2 years ahead of the curve when it comes to coming out of that deep hole in which they found themselves in over the last 2 to 3 years as compared to the PSU banks. So the priority has to be private sector corporate banks and then the PSU banks, and that too within the PSU banks, there is a hierarchy itself in terms of the operating profit and how much that is in relation to the net NPAs which is sitting in those banks.
Let's also talk about the outlook on, other sectors like consumption as well. We had quite a bit of promise, and you had the sector which managed to deliver in the last year. Based on the kind of volume growth trends that we've seen, the management commentary as well that has come out, and the fact that the overall macro situation is what it's at, what are your, what is your assessment rather of the consumption space? Are you finding comfort here?
On the consumption side, I think the drivers of the consumption are there, and I'm talking more of FMCG and not discretionary. But the FMCG consumption trends are pretty robust, and even though there could be a slowdown from the last year's very high growth rate of high single digits, I think the gross margin improvements, the margin improvements, the volume improvement trends are going to be looking pretty good for this year. The question there is obviously on the valuations more than the earnings. I think the earning visibility is pretty strong there. And on the valuations, therefore, since the valuations are at a 10-year high, I think one needs to be extremely careful about owning companies where we still see a trajectory of earning upgrades, however minor that might be, rather than owning companies where there are risks to the downside in terms of earnings, however minor that might be. So clearly it's become a much more finer game in terms of owning and deciding between the stocks in consumption as compared to last year. And so is the case in, for example, in IT services. Last year you saw an earnings upgrade cycle as well as a valuation re-rating cycle. This year the valuation re-rating is already over, so we are going to be owning or trying to find companies rather than owning the sector as a whole. So therefore both these sectors which did very well last year is now all about bottom-up stock picking, even if they are large caps.
Are some of the smaller NBFCs a concern, Rahul? Because what happened with the Reliance Capital subsidiaries, Reliance Home Finance, and thereby the downgrade then coming in from Care and ICRA, would you also keep an eye out for other weak NBFCs wherein the payment schedule is coming up for MFs and they do run a high risk of a default?
Yes, we constantly watch them. We don't own many of them, but we do constantly watch them because it has systemic implications in terms of how the flow of credit to NBFCs, which has already got impacted, could get impacted further or could slow down further. So therefore, the implications are not just on one particular stock or one particular company, but on the entire funding ecosystem as a whole. In terms of the companies which we like in NBFCs, it has to be companies which have had a long legacy, not necessarily having very lumpy wholesale book, have a more diversified book, more retail diversified book, and also something which has a strong parentage. I think those companies will survive this test, even if they will go through a temporary compression in the NIMs, which you would have, if you've seen the results, most of the results are showing that. I think those are temporary cyclical factors, but some of those companies are available at reasonable valuations, and therefore that is the space really to go after rather than very small NBFCs.
Thanks so much for joining us, Rahul. Good chatting with you this morning and getting a sense from you on some of these pockets of the market.